Hello, very good morning to all, and welcome to a brand new week ahead. And I'm Kelvin here. Good to be back after a 1 week break. I hope that you all have a good, restful weekend. Very good morning. Welcome to today's Daily Dose. Today will be Monday, the 26th of August, 2024. So before we jump straight into today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the intraday short-term technical outlook on the major cross-asset classes, let's have a recap what has taken shape on last Friday, followed by what are the current key medium-term intermarket dynamics and fundamentals that we should be paying attention to. And lastly, we'll actually talk about what are the key economic events for this week as well as for today to watch out. All right, so as we know that last Friday was actually Jackson Hole. So during this Jackson Hole symposium, it's actually a gathering of the developed nation central bankers, and most importantly, all eyes and ears are on Jerome Powell, which will indicate what is his stance on the current US monetary policy. So actually what Powell did over here is that he didn't actually surprise the market that much, and he actually kind of reaffirmed that the Fed will actually most likely will start easing in the September FOMC meeting. Then that was already priced in by the markets 1.5 months ago. So he actually uses Jackson Hole symposium to actually reaffirm the change of stance among the Federal Reserve officials from keeping rates higher for a longer period to actually start thinking about cutting rates. But what he actually falls short, other than saying that time has come over here, okay, for easing, all right, he didn't actually mention or state very clearly about the size and the path of easing. That means, i.e., in terms of the timing, how long will the interest rate cut cycle will be, and after after the September FOMC meeting, what will be the magnitude of the interest rate cut? So if you look at the current CME Fed Watch pricing tool over here, so for those who are actually unfamiliar to what you see on the screen over here, just go to CME website and you're able to actually get a gauge of the current interest rate futures pricing. That means using the 30-day Fed funds futures pricing, and CME has a Fed Watch tool that they calculate for us based on the current price action of the 30-day Fed funds futures, what market participant in the interest rate futures market expecting the Fed funds rate will be during the various respective FOMC meeting. So we know that the next FOMC meeting is actually due on the 18th of September over here. And the current Fed funds rate is 5.25% to 5.5%. So how do we know that? You just click on current, you're able to see the table. Yeah, this is the current target rate, 5.25% to 5.5%. So there's a slew of tab over here. So straight away, I can just click on aggregate. It gives us a slew of probability going ahead to close to 1 year down the road based on the next FOMC meeting. So the next one will be 18th of September. So based on the current Fed funds rate of 5.25% to 5.5%, there is actually a high chance of 62% probability that based on current interest rate Fed fund futures pricing, the market is pricing 25 basis point cut of a high probability of 61% to bring it down to 5% to 5.25%. Only a 38% chance of a 50 basis point cut. All right. So as we know that in the last few days, retail sales or last few weeks, several key US economic indicators is not actually pointing to a hard landing or a recessionary-like scenario in US. So that actually reduces the 50 basis point cut for the upcoming September FOMC meeting. on 18th of September. So that actually explains to us why the 50 basis point cut now has a lower probability of less than 50%. All right. But what's interesting over here is that after the first expected cut that's being priced in by the interest rate Fed funds futures as calculated by this CME Fed Watch 2, the market has started to look out for 50 basis point cut. How do we know that? Because if you look at 50, 5%, 5% to 5.25%, the next rate cut over here will be bring down to 4.5% to 4.75%. So that's actually indicating of a 50 basis point cut or 0.5% cut. We have a high probability of 78 or 79% chance. All right. Then thereafter, another 25 basis point cut before the year ends on the 18th of December FOMC meeting. So that's actually a high odds of 81%. You could see over here to bring it down to 4.25% to 4.5%. So the path of the market expectation right now is the first cut expected probably will be 25% point based on the probability of the higher probability as implied by the CME Fed Watch 2, then 50 basis point cut to bring it down to 4.5%, and another potential 25 basis point cut before the year ends to bring it down to this 4.25% to 4.5% on the 18th of December FOMC meeting. And thereafter, there will be more like a kind of a gentle 25 basis point cut each. That means it's not every other meeting. I mean, it will tends to hold again, okay, during the March meeting. Yeah, the March meeting over here, right? Okay, but that we got to actually look into at that point in time what are the current state of the US key economic indicator like retail sales, non-farm payroll data, ISM manufacturing, ISM services. All right, but for now, the next 1, 2, 3 meetings of the FOMC meeting, this is the kind of a expected directional and expected pace of cuts that's being implied by the CME Fed Watch 2. And how does this react to the market? For sure, we start to see the dollar weakening. So what we see over here is that the dollar index, before I went for my 1 week cost break over here, let me share with you. Yeah, so this is the dollar index. So the dollar index has to actually stage a meaningful bounce to retest the 20-day moving average, and in the end it collapsed all the way and broke below this kind of a symmetrical triangle range support that is in place since 17th of July, and also broke down the previous low that was seen on February 2023. All right, so now the dollar is now trading close to its lowest level since about 1 year ago, and the next meaningful support level very likely will be this low here, this minor swing low, this swing low area of 14th of July. All right, 14th of July, and at 99.60, then thereafter followed by 97.85. So on a medium term perspective, the dollar is more inching towards a medium term downtrend phase, but we know that price action don't go one way straight down. This is a daily chart. During the intraday basis, there could be some kind of bounces here and there on the dollar strength. We call it weakness snapback rally. That means a kind of dead cat bounce. So that we will cover more in our intraday technical outlook on a daily basis on those major dollar pairs. All right. And also this dollar index that is shaping this ongoing medium-term downtrend scenario right now. Okay, let me put this in highlight in red because it's really broken down, this line over here. Okay, has been supported by the further weakness in both the 10-year US Treasury yield and as well as the 2-year Treasury yield. So you look at the 10-year Treasury yield over here is that ever since the retest on 5th of August at this support at 3.78%, it has been trading in this kind of corrective dead cat bounce scenario, can't really break above the downward sloping 20-day moving average. So now this downward sloping 20-day moving average right now is acting as a resistance, okay, at around this 3.9% level. So all in all right now, it seems to be momentum is weak as well. There's no bullish divergence over here. We see a series of lower high that's being depicted by the RSI as well. Okay, so indicating to us that there's a high chance that it may starts to break down below last Monday, the 5th of August, the 5th of August Monday swing low at 3.78%, with the next big support level to look out for will be at 3.3%. So further weakness in the US 10-year Treasury yield. All right, so that could actually also later I'll share with you some of the intermarket dynamics on the impact of this weakness of the US 10-year Treasury yield. And what we could see right now over here is that the shorter term 2-year Treasury yield is actually moving down at a greater downside magnitude compared to the 10-year. Why? Because if you look at, okay, this is the low of 26th of December, all right, and the low of 2nd of February, right, hasn't really broken down yet, okay, in clear step. But the 2-year Treasury yield, the one that is much more sensitive to the US monetary policy, very clearly has really broken below the February low, okay, the February low right over here. It now turns into a pullback resistance. So ever since the bounce off from 5th of August on Monday low, it fails to actually break above the 4.12% pullback resistance. We saw confluence with this downward sloping 20-day moving average. So now very important, this will be a zone level to watch to maintain its medium-term downtrend for the 2-year Treasury yield. That means at 4.02% and 4.12%. So the next big support level to watch will be at 3.63%, which is also the long-term pivotal support that was being held on the 5th of August minor swing low level. So if this level starts to break out, the 2-year Treasury yield will definitely go down much lower to actually test 2.84% next. So net overall, what we could see over here is that both the 2-year and the 10-year are declining in a downward, I would say that medium-term downtrend phases, but the 2-year Treasury yield is actually dropping at a faster pace compared to the 10-year, as I show you, because the 10-year hasn't broken below the its February low yet. All right, so what it means over here is that market participants are still looking out for a potential soft landing scenario in the US economy. That means not actually pricing in a very high odds of a recessionary like scenario. Why? Because the 10-year is dropping at a slower pace than the 2-year, or the 2-year is dropping at a faster pace compared to the 10-year, and the 10-year Treasury yield is more or less linked to the economic condition of the US economic condition. So if the US economic condition starts to slip into a recessionary scenario, or there are more odds of data supporting a US recession has already in play, the 10-year will drop at a faster pace. That means they will play a catch up, because the 10-year US Treasury yield is linked to economic growth condition. That means if the US economic growth slip into a recession, that means there will be deflationary risk compared to inflationary risk. All right. Whereas the 2-year Treasury yield is more sensitive to the path of US monetary policy, where market participant has now started to price in the start of an interest rate cut cycle in September FOMC meeting. All right, so this is the current situation right now, and eventually you also start to see a risk-on scenario globally in the major US stock indices and trickling down towards the rest of the world as well. So I could see this was last Friday price action over here. So almost all in the green, being led by the mega cap technology stocks, but it tends to spread out towards the rest of the other sector as well, consumer cyclical, energy, as well as financial. So it's I would say it's more like a healthy rotation into the general US stock market in terms of their sector performance. That was on last Friday. And if you look at from a weekly basis, all right, go into groups. So let me expand my screen. So this is the 11 key sector on the S&P 500. So the 1 week performance has been spread to the previous laggard, the real estate, basic materials, and industrials, that managed to actually benefit from this more or less reaffirm Jerome Powell, Jackson Hole's speech to kickstart the potential first interest rate cut in US in the September FOMC meeting. And bearing in mind that given that the 2-year Treasury yield is falling at a faster pace than the 10-year Treasury yield, that is actually signify a steepening of the US Treasury yield curve, less likely chance of a US recession at this point in time. So that actually show us the longer term 1 week performance of the laggards outperformance against the mega technology stocks, which is only gaining 1.12%. So the laggards, the real estate managed to gain by 3.6%, the basic materials 2.5%, and the industrial 2.2%. Outperforming the mega cap technology stocks, which is part of this info technologies S&P 500 sector, only gaining 1.12%, and in fact that was the worst performer last week, the second worst performer last week. Okay, slightly on top of the energy, which still has a negative weekly loss of slightly negative 0.2%. All right, so that is the key data events that took shape last week and last Friday, and its impact on the major cross asset classes. And one thing I want to share with you all is there's this particular news out from BOJ as well. So that actually also further supports this ongoing yen strength against the dollar. So during last Thursday and Friday, there was actually a testimony by Bank of Japan Governor Yuda in the Japanese parliament. He actually signals a readiness to rise rates if growth and inflation remains on track. And so far, we know that Japanese inflation has been pretty much hovering about steady after the prior 3 to 4 months of decline, which I covered in the previous daily dose, and as well as its latest services PMI data continues to tick up higher. All right, so very likely there could be another 25 basis point hike by BOJ before 2024 ends. So that's why you see the divergence of path in Bank of Japan, followed by the Fed, which is on the start of an easing mode. But so far right now, like what we see, as long as the US economy, there's no clear signs of a recession. That means as long as data doesn't indicate recessionary scenario in US, there could be still a risk-on scenario taking shape in the global stock indices. That means the push-up in the Japanese yen, that means the yen strengthening, seems to have a much more lower sensitivity towards the risk-off scenario, like what it did previously in the late part of July and the first week of August, where we start to see yen strengthening. It triggered off a risk-off scenario where we see global stock indices selling off at that point in time. Because at that point in time, there was actually some data that indicate the US economy may slip into a recession, which is a very weak non-farm payroll data, and as well as the tick up in the unemployment rate. So these are the data that we got to be focused on as we head into another week from now. Yeah, because where we start to see the US release the latest ISM manufacturing PMI and services data next week. All right. Now, with that, that pretty much sum up what we have so far that has taken shape on last Friday. And what is interesting to watch out for right now is this ongoing geopolitical tension in the Middle East that could actually see a rebound in the in oil price. So very interestingly, before I went for my break, we will have a bearish bias on the WTI crude oil price, but we highlight a key support level to watch, which is around the $73-74 per barrel. So that was actually a major range support. And what's interesting over here is that crude oil actually bounces right at the 73-72 major range support that we highlighted earlier on the West Texas crude oil. In line with what we see over here is there's this very interesting flare out in Middle East geopolitical tension, where Israel yesterday actually they jumpstart to actually start to bomb the southern Lebanon to actually thwart Hezbollah revenge attack. All right, so they actually jumpstart ahead before Iran and Hezbollah retaliate due to this revenge killing of the Hezbollah commander that's been deemed being killed by Israel 2 or 3 weeks ago. Okay, so something to take a look out for as this ongoing geopolitical Middle East risk tension in the Middle East may support oil prices above the $73-74 per barrel. So later I'll touch more about that when we cover the intraday technical outlook on the West Texas crude oil. All right, so that actually kind of sum up the things to look out for in terms of the events, news flow, and its impact on the major cross asset classes. Now let us shift now our attention to more of a medium-term time horizon. That means it's kind of a multi-week time to multi-month time horizon in terms of fundamentals and their intermarket dynamics. All right. Okay, so like I mentioned earlier here, let's take a quick look at this particular chart. All right, so this particular chart I did flash before in one of my daily dose, but let me flash again because right now very clearly the Fed is about to pivot from keeping rates higher for longer to start cutting rates and kicking start a interest rate cut cycle. But the most important thing over here is, has the US economy slipped into recession? So what I did over here is all the way from 1957 until now, the current rates, I take a look at their previous interest rate cut cycle all the way from 1957. And after the first cut, how did the S&P perform 3 months, 6 months, and 12 months after, and whether is the economy, US economy, slip into a recession. All right. So what I did over here is that there's actually 8 Fed pivots that occurred during the recession period since 1957, and S&P 500 fared the worst during these Fed pivots. That means during this recession period of October 1869. That means they kickstart the first interest rate cut in October 1969. Okay, not 1969, and the U.S. economy has already been in recession. And 3 months after, 6 months after, 12 months after, the S&P 500 declined by double digit. That means negative 13%, negative 12%, negative 16%, and negative 14%. And very similar during the dot-com bubble as well. Okay, when the Fed engineered its first interest rate cut in January 2011, 3 months later, the S&P 500 slipped by negative 5%, then 6 months later, negative 8%, followed by negative 14%. All right, then followed by, this will be the most recent GFC, the Great Financial Crisis, triggered by the US subprime mortgage crisis, or the subprime meltdown. All right, the S&P declined by negative 6%, 3 months after, negative 13%, 6 months after, and negative 24%, 12 months after. So the only occasion that was rather mixed was in August 1981, where the S&P gained by 2.9% after 3 months after the first cut in August 1981. The economy also is already in recession at that point in time, and 6 months after, it lose negative 8%, and 12 months after, it lose negative 3%. So this one was rather mixed, despite the fact that the economy was in recession. And the only exception case was in November 1957 and November 1960, over these two periods, where the US economy has really slipped into recession, but the S&P 500 managed to have a positive return 6 months after. Yes, 3 months after, it was negative after the first interest rate cut. That means the Fed pivot in November 57 and March 60. The 3 months after the first interest rate cut during this period, the S&P declined by negative 3% and declined by negative 6% in May 1960. But 6 months after and 12 months after, it produced stellar returns, especially 12 months after, where the index rose by 26% after the first interest rate cut introduced in November 57, and 14% after the first interest rate cut was introduced in May 1960. And during this two period in time, the US was in recession. So net overall, what we could see over here is that there are actually more instances when the US is in recession. The Fed engineered its first interest rate cut. There are more instances that the S&P 500 is showing lackluster performance compared to sterling outperformance, which was the rare case was in November 1957 and May 1960 during these two period over here. Okay, so there's some important data we got to take a look of. That means, i.e., the next few weeks of data will be very pivotal, will be the US non-farm payroll data, as well as the ISM services, ISM manufacturing data, and consumer confidence data, and followed by retail sales. So these are the 5 data to have a gauge for us to see whether the odds, whether the US is slipping into a recession already or not. So that will be covered much more in deeper depth as in my next few days of daily dose as we come closer towards the release of such data. All right, so let's say if the US economy is not in recession, all right, that means everything is fine. Okay, we're talking about the Goldilocks scenario over here. So what we could see over here is that right now we are having this so-called potential bull curve steepening play back into play again. That means, i.e., the difference between the 10-year and the 2-year yield spread is right now moving into positive territory. So still recall that during the January 2022 all the way down to the May 2023 period, everyone was looking out for the yield curve inversion scenario. So a yield curve inversion scenario actually is a leading sign that the US has really slipped into recession. So given that if the odds of the US recession is getting lesser and lesser, and with this potential bull curve steepening, that means looking to break above a key resistance at negative 0.08%. That means where the 2-year is actually dropping at a faster pace compared to the 10-year. So this is where we have the bull steepening taking shape. Potentially, we could start to see a outperformance of the laggards. That means, i.e., the value related component stocks inside the S&P 500 will start to outperform against those stocks that are momentum driven. So momentum driven are considered as the mega cap technology stocks right now. So how do we see that? Is by plotting the ratio of the S&P 500 momentum ETF against the normal weighted S&P 500 ETF, which is the SPX. So this is very easy to actually obtain from TradingView by just typing a ticker SPMO. So basically what the Invesco is the fund manager that created this momentum S&P 500 momentum ETF. So what they did over here is they re-rate the 500 component stocks accordingly by the momentum factor. That means those S&P 500 stocks that's higher momentum factor rankings will be ranked at the top. So that will be given shape like Nvidia, Meta, Amazon, Facebook, the mega cap technology stocks. And those who have lower momentum reading will be ranked at the bottom. Okay, so this is how they do it. And they have another one, a value weighted S&P 500 ETF, also by Invesco as well. The ticker code is SPVW. So what they did over here is that they re-rank the S&P 500 index according to the value factor. That means those stocks has value oriented weightings that has a higher ranking. That means value, it could be lower debt ratio, those various one of the key component, perhaps sustainability in the revenue, because that's a revenue well, high book to high price, we call it low price to book value. Over here considered a value factor as well. So example will be like financials, consumer, discretionary stocks that's a higher value compared to those mega cap stocks will be ranked at the top, okay, in this S&P 500 enhanced value ETF as SPVW VU, okay, SPVU in terms of the ticker. And if you look at previously during the after the onset of the pandemic in November 2020 all the way up to March 2021, we see another round of bull steepening of the US Treasury yield curve. This also lead to the value factor in the S&P 500 to outperform the normal S&P. We could see over here, and during at that point in time, the momentum factor underperform the S&P inside the S&P 500. And what we could see over here right now, yes, we're going to see the outperformance of the S&P 500, but we realize that the momentum, the value factor now has started to shape a higher low. All right, a higher low already. That means there's some signs of initial stages of potential outperformance of that is may take shape on the value side of the story inside the S&P 500 against the normal S&P 500 index. So this is being supported by the potential bull steepening of this US Treasury yield curve, and for sure the deciding factor will be the breakout of that, the bullish breakout of that negative 0.08%, this red line over here. All right, and if you could overlay, so this is based on a sectorial rotation performance basis. But if you look at from an index performance basis, that means looking into the Dow Jones, the Russell, and the Nasdaq 100, which is a momentum play as well. All right, by plotting this over here. Okay, let me put it in. Okay, one bit. Okay, so at the bottom is still no change. The purple line is the US Treasury yield spread. All right, means taking the 10-year minus the 2-year, and the very similar potential bull steepening that we see earlier on, that I highlighted earlier, and the negative 0.8% key resistance level that equal to stage that bullish breakout to reinforce this potential bull steepening. And what we could see over here is that this top of the chart is the ratio between the Dow Jones Industrial Average versus the Nasdaq. So think of it as Nasdaq 100 is the momentum play within the major US stock indices, right? Because Nasdaq 100 heavy weighted towards the mega cap stock, so it's a momentum play. Everybody knows that. And the Dow Jones and the Russell are the laggards, all right? They are constituted of small cap stocks, which is more or less related to has higher debt ratio. Dow Jones Industrial Average, which is considered as a value factor as well, because it's heavily weighted on the financials and the healthcare, as well as some industrialized stocks like Caterpillar. Okay, and if you look at since the October of 2022, it has been underperforming the Nasdaq 100 and the Nasdaq 100. That means the Dow Jones and the Russell has been underperforming the Nasdaq 100 by these two ratios over here. All right. Okay. And what's interesting over here is that right now the potential bull steepening is taking shape. The ratio of the of the Dow Jones over Nasdaq and Russell 2000 over Nasdaq has started to shape a higher low as well over here. So potentially, if there's a further breakout above negative 0.08% on this US Treasury yield curve to reinforce this bull steepening pace of the US Treasury yield curve, also provided that the US economy doesn't slip into a recession, that means low odds of a recession. Over here, that means we do not see a very further weakening in the US labor market as indicated by the non-farm payroll data and the US unemployment rate, and as well as the ISM services PMI and ISM manufacturing PMI. Potentially, we may see further potential outperformance of the ratio of the Dow Jones Industrial Average and the Russell 2000 against the Nasdaq 100 continues to actually trick up higher, like what it did previously during the previous bull steepening of the US Treasury yield curve, by taking the difference of the 10-year minus the 2-year during the post-pandemic period of April 2020 to March 2021. Over here at this instance is time where the ratio starts to tick up higher. All right, showing the kind of medium-term outperformance of the Dow Jones Industrial Average and the Russell 2000 over the Nasdaq 100 during that point in time. But that is a big if. This will only could happen provided that the leading US economic data, like I shared with you all, ISM services, ISM manufacturing PMI, US consumer confidence, retail sales, non-farm payroll data, and the unemployment rate doesn't show signs of US slipping into a recession. All right. Okay, so that sum up the intermarket dynamics, okay, that I share with you all, and the medium-term fundamentals that is taking shape right now. All right, the importance of it, the more important of it. So now, before we start our intraday technical outlook, let me expand my screen so that you guys could see much clearer over here. So let us start the intraday technical outlook on the FX market first. So before we jump straight into the individual FX pairs, let me share with you all what has taken shape on a very short-term basis, all right, on the US dollar against the major currency as of now, 26th of August. So what we could see for sure at this point in time, we start to see a deterioration of the dollar against all the major currency. That also the worst hit was the Swiss franc and as well as the dollar yen, followed by the sterling pound. That means the dollar is the weakest against the sterling pound, the Japanese yen, and the Swiss franc. But across the board, we start to see a declining US dollar weakness declining US dollar against the rest of the major currency. So if you look at from a rolling 1 month basis, right, very clearly it actually showing dollar weakness as well. All right, so with that, let us now jump straight into the intraday technical outlook, starting with the euro dollar first. All right, so the euro dollar continues to actually trend higher, okay, on a short-term basis. Right now, breaking above the 20 and the 50 moving average, and starts to oscillate within the short-term ascending channel that I drew from the low of 2nd of August. And what we could see over here is that last Friday push up exposed Jackson Hole Symposium. That means exposed Jerome Powell speech in Jackson Hole. The RSI has started to hit the overbought level and now is exiting from the overbought level. So indicating there's a chance of a minor pullback first, but rather than a bullish or a bearish reversal. Why? Because there is no bearish divergence that's being seen on the hourly RSI. So with that, I'll be using 1.11 short-term pivotal support for today. So as long as this pullback, okay, first pullback level to watch will be at 1.1160, 1.1130. This is the first zone to watch for the potential minor pullback. But as long as this minor pullback, this minor potential pullback didn't surpass below 1.11 short-term pivotal support level, the honors on the euro dollar is to be on a bullish bias on the intraday basis. So we do have a bullish bias for today on the intraday basis, as long as the minor pullback didn't surpass below 1.11 short-term pivotal support. Next resistance level to watch on the intraday basis for today will be at 1.1235, followed by 1.285 and 1.13 figure level, which correspond to the upper limit of this minor ascending channel and very close to this long-term descending trend line, this line that is in red since the high of March 2008 over here. Only an hourly close below 1.11 figure level will invalidate today's intraday bullish bias on the euro dollar to see a much more deeper corrective, minor corrective pullback scenario to unfold to expose the next near-term support level at 1.1050, followed by 1.1050, followed by 1.10 figure level, which correspond to the upward sloping 20-day moving average as well. So that's for the euro dollar. Moving on will be the sterling dollar. So the sterling dollar also continues to actually be involved in a short-term bullish dynamic by depicting its price action that going to oscillate within this minor ascending channel since the low of 15th of August. And right now the price action has really hit the overbought level and starts to exit from its overbought level as well. But prior to that, RSI didn't shape a bearish divergence, right, moving in line with the price action, so indicating there is a low odds of a much more deeper minor corrective pullback that may take shape. So what I could see over here is that potentially the short-term intraday uptrend still remains intact, but do not forget, price action don't go vertical or up, there will be a risk of a minor pullback over here. So as long as this minor pullback didn't surpass 1.3130, that's the short-term pivotal support I have for today. Also the minor bullish breakout level that has taken shape on last Friday now turns into a pullback support level. So as long as this potential minor pullback due to the exiting of this overbought level on the RSI right now, as long as this minor pullback didn't surpass below 1.3130, we will have a short-term intraday bullish bias on the sterling dollar. Next resistance level to watch will be at 13340, the 2 times 6.8 Fibo extension level, followed by another extension level over here one time at 13410. Next, only an hourly close below 1.3130 will invalidate today's bullish bias on the sterling dollar to kickstart a much more deeper minor corrective decline to expose the next near-term supports level at 1.3040, followed by 1.2940 next. All right, so now with that, let us now focus our attention to the Asia Pacific currency against the dollar, starting with the Aussie dollar. So let's look at the Aussie dollar chart first. So on the Aussie dollar chart, ever since the bounce off from the 6360 medium-term pivotal support level, so that is also the major trend line support that I drew from October 2023. The next resistance to look out for will be at 69 figure level. This kind of a range top since the high of 15th of June. Okay, that prevents any further upside one time. 2 times and around Friday 3 times over here during last year December, and also is a long-term circular descending trend line from the 25th of February 2021 high. All right, so this is pretty much key range resistance to look out for in this ongoing short-term intraday bullish momentum that is still taking shape on the Aussie dollar. All right, so with that, let us shift our focus now on the hourly chart to pinpoint the short-term pivotal support level to watch. Okay, so as usual, price action now managed to trade above the 50, 20, and the 50-day moving average, continues to be in a short-term intraday bullish dynamic by price action that's been oscillating in this minor ascending channel since the low of 5th of August over here. And the top of the channel also correspond to the upper limit at 69 figure level. All right, so next resistance level to watch will be 68.47, 68.90/69. But however, the RSI now has started to exit from last Friday overbought level, so there could be a risk of a minor pullback first. So first minor pullback support level to watch will be at 67.50, followed by 67 figure level, which is close to the minor ascending channel support. So as long as this minor pullback didn't surpass below 67 figure level, we will have a short-term intraday bullish bias on the Aussie dollar, with next near-term resistance level to watch will be at 68.47, 68.90/69 figure level. Only an hourly close below 67 figure level will invalidate today's intraday bullish bias on the Aussie dollar to trigger a much more deeper minor corrective decline pullback scenario to expose the next near-term support level at 66.40, which correspond to the 50-day moving average. Below it exposes 65.90, which correspond to the 200-day and the 20-day moving average as well. Okay. Now, lastly, on the FX market will be the dollar yen. So dollar yen, before we go on our on my 1 week break, we do have a bearish bias. Why? Because it continues to trade below the 20 and the 200-day moving average, as well as the 50-day moving average. And what we could see, price action continues to remain kept within this medium-term ascending channel that I drew from the high of 11th of July. Right, it's still being kept within this descending channel. So net overall, the top of this medium-term ascending channel right now is at 145.50 level over here. Okay, 145.50 level, and it has broken. Okay, right now it's broken below this 144.20 level. Okay, so with that, the RSI now has managed to exit from the oversold level. So now there could be a chance that the dollar yen might shape a minor pullback scenario, okay, towards this 144.70 level, maximum 145.45. So as long as 145.45 didn't surpass to the upside in this ongoing minor snapback bounce, we will still maintain that short-term intraday bearish bias using the tightened short-term pivotal resistance at 145.45. Next support level to watch will be very close to the 5th of August low area at 154.60/40, followed by 140.25, all right, which is this congestion area over here. Okay, this swing low of 29th of December. But however, if we start to see a push up with hourly close above this 145.45 short-term pivotal resistance that we have for today, it will invalidate today's intraday bearish bias on the dollar yen to kickstart a much more substantial mean reversion rebound scenario to retest the 20-day moving average, acting as a resistance at 147.50. Above it exposes 149.30, which is the minor swing high area of 15th of August and 16th of August. Okay, so that's the intraday technical outlook for the dollar yen and as well as the major FX pair. So now with that, let us now shift the focus towards the major stock indices, starting with the Asia Pacific Stock Index first, which is the Hang Seng Index, right? The Hong Kong 33. So the Hong Kong 33, before we went for our break, we do have a bullish bias for a bounce as price action managed to survive at the 200-day moving average. So with that over here, today's price action managed to actually surpass the last Monday's swing high at this 17,750. And but I don't want to use this level as my key short-term pivotal support level for today. I'll push it slightly lower, which is at 17,550. So as long as any minor pullback that managed to be held at the 17,550 short-term pivotal support level, we also correspond to the 50-day moving average, I think as a similar support level as well. We'll still maintain this ongoing bullish bias on the Hong Kong 33 as it continues to oscillate within this minor ascending channel since the low of 5th of August, with the next intermediate resistance to watch out for will be at 18,070/18,160, which correspond to the 0.618 Fibo extension level taken from the low of 5th of August to the high of 19th of August, project it to the low of 21st of August, and as well as the upper boundary of this minor ascending channel that I drew. However, an hourly close below 17,550 will invalidate today's intraday bullish bias to kickstart a much more deeper corrective pullback to expose the next support level at 17,430, followed by 17,270. Okay, so going forward over here, we will focus our attention next on the Japan 225, right? So the Japan 225 starts to actually turn slightly weak after the failure to break above the 50-day moving average that is acting as a resistance, and also broken below its minor ascending channel support that I drew from the 6th of August level. So right now, the Japan 225 is at risk of shaping at least a retracement to retrace this minor push-up phase or minor uptrend that has previously taken shape from the low of 5th of August all the way up to last Friday high. And momentum is also very weak as well, because prior to last Thursday and last Friday high push-up, the RSI has really staged a bearish divergence, all right? And what we could see, the price action right now has broken below a parallel support on the RSI over here, indicating to us there is some form of minor downside momentum that is inherent right now in the Japan 225 index, at least from a intraday short-term basis. So with that, I'll be using the pullback line over here, which is the pullback's support of this minor ascending channel, now turns into pullback support, also very closely to the 50-day moving average, I think as a resistance, 38,430. So using 38,430 as my short-term pivotal resistance on the Japan 225, and we will have a short-term intraday bearish bias on the Japan 225 for today. First support level to watch will be at 37,480, which correspond to this minor congestion area over here from 19th of August and 16th of August, also corresponding to the 200-day moving average, acting as a support level as well at 37,480. A breakdown below 37,480 may see further potential weakness to retrace much more deeper towards the next near-term support zone at 36,885/36,630. Only an hourly close above the 38,430 level, that means a breakout above it, will invalidate today's intraday bearish bias on the Japan 225 to see the continuation of its impulsive up move to expose the next near-term resistance level at 39,270, followed by 40,055 next on the Japan 225. All right, now moving on will be the one of the benchmark European stock index will be the German 30. So the German 30 continues to be evolved in a short-term bullish uptrend dynamic since the low of 6th of August, as it managed to surpass the 50-day and the 220-day moving average, and as well as the 200-day moving average as well. So net overall, it seems to us that it's now shaping this ongoing short-term uptrend phase. So with that, the RSI has really exited from its overbought level since on last Friday, and potentially it could actually shape a further potential pullback over here on the RSI before hitting this key parallel support level at around the 42 level. So that also should correspond to the short-term pivotal support level as well, which was last Friday's swing low, and it will correspond to the minor ascending channel support that I drew from the low of 6th of August. So as long as this minor pullback didn't surpass below 18,450, that's our short-term pivotal support that we have for today. We will have a short-term intraday bullish bias on the German 30. after the first support resistance level to watch, 18,690, followed by 18,880, then thereafter followed by its current all-time high at 18,935 / 19,025 Fibo extension level, and as well as 19,025, this Fibo extension level of 3.618, followed by also close to the upper limit of this minor ascending channel as well. Only an hourly close or a breakdown below 18,450 will invalidate today's intraday bullish bias to expose the next near-term support level at 18,350. A breakdown below it may see a further or a deeper minor corrective pullback scenario to unfold to expose the next near-term support at 80,040. We also correspond to the 20-day moving average, acting as a similar support level as well. Okay, so that's for the German 30. Moving on will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to be in a bullish dynamic as well, as it managed to actually oscillate within a short-term ascending channel since the low of 8th of August over here. But however, with the RSI now exiting from the overbought level, there could be a risk of a minor pullback taking shape first before continuation of its impulsive up move. So with that, first resisted support level to watch for this minor pullback will be at 40,960. But I will not use this as my short-term pivotal support just in case of any further whipsaw level. I'll use last Friday minor swing low at 40,610. So as long as this minor pullback didn't surpass maximum 40,610, short-term pivotal support level that we have for today on the US Wall Street 30, i.e. the Dow Jones Industrial Average, we will have a short-term intraday bullish bias on the US Wall Street 30. Above 41,230 exposes the next near-term resistance zone at 41,425 / 41,535 next, and above it sees 41,800, which correspond to the upper limit of this minor ascending channel as well. All right. Now, with that, let us shift our focus to the Nasdaq 100. So the Nasdaq 100 is kind of mixed. Over here on last Friday, it didn't manage to shape a higher high. I mean, it didn't actually break even the Thursday high at 19,900, and it managed to actually break below the minor ascending channel support. Now turns into a pullback resistance over here that was rejected on last Friday, and the RSI continues to trend lower high over here. So with that, I would say it's a rather mixed bag scenario, but it managed to be held above the 50-day moving average so far. So for the Nasdaq 100 for today on an intraday basis, likely it will trade in a sideways range. So given this mixed element, we will maintain a neutrality stance for today on the Nasdaq 100, neutral between 19,900 and 19,460. Only an hourly close above 19,900 will see the continuation of this impulsive up move to expose the next near-term resistance at 20,190, followed by 20,455 / 20,615 next. Okay, on the Nasdaq 100. Right, with that, that sum up the intraday technical outlook on the major stock indices. So let us now focus our attention towards the major commodities, starting with gold XAU/USD. So gold XAU/USD continues to print new high, fresh all-time high, supported by this lower 10-year US Treasury yield, which lower down the opportunity cost of holding gold. So with that, I'll be using this former breakout point over here. So previously, this was something like a symmetrical triangle range configuration. Breakout retested on Friday and managed to survive and stage a bounce. So with that, 2,473 will be my short-term pivotal support level for today. So as long as 2,473 short-term pivotal support holds in any minor pullback, we will have a short-term intraday bullish bias on gold XAU/USD. First resistance to watch 2,532. A breakout above it exposes 2,588 / 2,595. All right, which is the upper limit of this major ascending channel as well that I drew from the low of 5th of October 2023. Okay, now going back to the hourly chart again. But however, if we start to see an hourly close below that short-term pivotal support that we have for today, that means at 2,473 for gold, we will start to see the start of a much more pronounced minor corrective decline taking shape to expose the next near-term support level at 2435/2415, which correspond also towards this rising 50-day moving average as well. A breakdown below 2415, then that could actually put this short-term uptrend in jeopardy again to see the retest of 5th of August minus swing low area at 2370 next. Okay, so that's for gold XAU/USD. Okay, so with that, now let us shift our attention now towards the next commodity, will be WTI crude oil price. So let's focus on the longer time frame chart first. So this is what I mean by previously we got to look out for this major range support level 73.15 level slash 71.35. It managed to hold on last Wednesday where the price declined and shaped a strong bounce of it. All right, so overall for gold, since the low of 20th of March 2023, it has been trapped within this major symmetrical triangle range configuration, and just that on last Wednesday it managed to hit the lower limit of this symmetrical triangle range configuration and stage a rebound. So net overall, from a multi-week perspective, we could start to see further potential upside in WTI crude oil to seek out 80.30 followed by 83 level. Okay, so what's that's from a longer term perspective level, but what's next, what's cooking on a intraday basis? So on the intraday basis, what I could see over here is that price action now is attempting to actually break above the 20-day moving average, so indicating some form of short-term upside momentum play that is taking full in the West Texas crude oil. So with that, I'll be using this former minor swing high now turns into a pullback support at 74.60, and if you do the Fibo retracement of this entire rebound that's taken shape from last Wednesday to Thursday to today's current intraday high, that also correspond to the 50% Fibo retracement as well. So as long as any potential minor pullback that could take shape in first step right now, because the RSI has really hit the overbought level, as long as this minor pullback didn't surpass below 74.60, we will have a short-term intraday bullish bias on West Texas oil. Next near-term resistance level to watch will be at 77.35, followed by 78.40 next, which will correspond to the 200-day moving average. I think as a resistance level as well, very closely at 78.40. Only hourly close below 74.60 will negate today's intraday bullish bias to see a further slide to retest the major range support zone at 73.15/72.24 next again. Okay, so that sum up West Texas crude oil intraday technical outlook, and as well as the intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar. What are the key economic data to look out for today? So today's key economic data on the calendar will be rather quiet, except we do have durable goods order for US out at 8:30 p.m. Singapore time. So that is the only key data to look out for today. And if you look out for this week itself, some key data to look out for this week, since we are at the start of the week, is to highlight is that it will start to occur on the middle part of the week, starting on Wednesday, monthly CPI data from Australia. And in Eurozone on Friday, we have the flash Eurozone preliminary data for the month of August. And most important is the core PCE inflation index that is out on US at 8:30 p.m. Singapore time. So that's all on Friday. And notwithstanding, on the earnings calendar, this will be impact on the major US stock indices, especially the Nasdaq 100 and indirectly the S&P 500, because the Nasdaq 100 and the S&P 500 move hand in hand. We have the heavyweight AI market leader, NVIDIA, will report its earning on Wednesday, August 28. So that is the close of the US session on August 28. So IE will be early Singapore, right after 4 a.m. August 29, Thursday, Singapore time. All right, so but we'll touch more about that when we come closer to these dates of economic data. All right, so with that, do have a great day ahead. This is Kelvin here, signing off, and we shall speak again tomorrow. Thank you.